I just want to welcome everybody to the webinar today. My name is Christine Jacobson of Conveyance Marketing Group, and I'll be your moderator for the Xenon ARC sponsored webinar, Economic Outlook 2023, Measures to Mitigate the Economic Downturn. It looks like 2023 is going to be a turbulent year as conditions pivot from inflation and tightening monetary policy, thereby the global economy. There are plenty of risks that are skewing global growth figures downward from 3.7% in 2022 to 1.2 or 1.8% in 2023, depending upon who you're talking to. It appears the Fed is also ramping up for potentially more hikes, resulting in the most aggressive tightening campaign in decades. And while Wall Street generally doesn't forecast the timing of recessions, approximately 60% expect a recession in 2023. But as Winston Churchill says, never let a good crisis go to waste. We'll be asking our panelists today to share their perspectives and how each plans to navigate and thrive in what could be one of the weakest years for the world economy in 40 years. And with that, let me introduce you to the panelists today. Jon Horvath is the Director of Economics and Market Dynamics at C.H. Robinson Worldwide. Jon spent 15 years on Wall Street as a fundamental stock analyst, which entailed forecasting industry and corporate earning growth. At C.H. Robinson, he leverages his experience forecasting costs of capacity, both in the short and long-term timeframes. Jon's big picture economic insights will kick off our webinar. Next is Cameron Hewes. He's the Managing Director and Head of Middle Market M&A at BMO Capital Markets. He's an accomplished middle market M&A professional with a track record of closing more than 125 successful advisory and financing transactions. Following on Jon's economic analysis, Cameron will provide insights into M&A environment, valuation trends, and discuss strategies to mitigate market risks and optimize M&A outcomes. Next, Paul Warburg. He's the president and CEO of Xenon ARC. Paul leads his company in developing innovative, tech-enabled solutions that drive performance for their clients in the materials industry by delivering value to their small to medium-sized business customers. In today's discussion, Paul will focus on new approaches that drive value creation, utilizing tech-enabled services to deliver holistic customer intimacy to SMB customers on behalf of their manufacturing clients. Brenda DeHart is Chief Financial Officer and Integrator at Edlong, a premier flavor solution provider focused on dairy and animal-free dairy type flavors. Brenda has a passion for taking innovative approaches to solving big challenges. Today, Brenda will discuss how Edlong made supply chain management a key differentiator amid the pandemic supply chain shortages and disruptions, enabling the company to achieve an unparalleled 95% on-time in full delivery of products to its customers. And with that, I am going to ask Jon to please take it away.
Thanks, Christine. Yeah, I wanted to start by kind of just framing where we are and doing kind of a growth snapshot. So where we're at right now is 22 had about 2% GDP growth, and the forecast for 23 is for about 1% real GDP growth. And Q4 is still yet to be reported, and you can see that in the diagonal lines on the far right in the slide. It's forecast by Wall Street at 1.6% growth on an annualized basis, and that number has been getting revised upwards. So that's a real positive. And that's after strong growth of 3.2% in 3Q, as you can see on the slide. Now, so since this webinar is about recession, What I like to look at to determine how the growth environment is the metrics that the National Bureau of Economic Research used to define recession. And I've got those 4 metrics below. So starting off with payrolls, the labor market, anything north of 200K is a good number. So these numbers for October, November are quite robust. And then, the consumer is 2/3 of the US economy. So let's look at real personal income ex government transfer payments. September and October were both quite robust, and November was even more robust. And then we've got real personal consumption expenditures. September, October, very robust. November was actually flat month on month, but these are still good numbers. So consumer incomes are good. Consumer is still spending, a little bit of downtick in November. And then moving to industrial production. September, 0.1% growth. October and November were both down slightly, but it was actually the utilities and mining component of industrial production, not manufacturing. Manufacturing is still growing slightly in the last few months. So net, this does not at all fit the recession bill right now. So the economy is holding up better, and really services rebound has been the near-term growth driver post the pandemic. And then if I get the next slide, please, Christine. However, it is likely we are in a recession by the end of the year. And the reason for that is that the first driver of this is inflation, just higher prices hurting demand and stealing people's spending power. And there's a few secular drivers of inflation going forward, but I'm going to focus on demographics in this presentation as the primary driver, and that's aging population, low birth rate, low immigration, and weak labor participation rates, which drives higher per unit labor costs. And then the second driver is, higher interest rates driving higher financing costs, and this layers on to higher inflation, right? So it's a double whammy: high inflation, high financing costs on top of high prices, and that's driven by the Fed rate hike cycle to fight inflation. And this just increases costs for everybody in everything. And then the third point is global slowdown, and that's a growth drag from China in the very near term. China has a huge growth drag right now. They have probably 5 million Omicron cases a day, but they'll be through that very quickly. And then Europe is probably in recession right now, and will be a drag on US multinationals. But let's keep in mind, most countries in the world are facing, number one, high prices, and number two, higher financing costs, just like the US is. And then we got a little bit of heightened geopolitical risk as well. Can I get the third slide, please? So let's talk about inflation for 1 second. As you can see on the right, this is consumer inflation, CPI. We're at low 7% right now, 7.1%, down from a peak of 9%, as you can see in the chart back in June of 22. Now, if we think about inflation kind of as an onion, so this inflation onion, the outer layer of inflation is driven by these pandemic supply chain issues. And that's that 6 to 12 month period that companies underinvested in people, in CapEx, in inventories. And the most notable example of this is the semiconductor shortage. And that drove all kinds of, a lack of availability of cars, and it drove up the prices of used cars very significantly. So the outer inflation layer is the pandemic snafus, and that mostly we're beyond right now. And if we peel that back, the second layer of the inflation onion is the cyclical layer, and that's kind of the long-term commodity investments. And these commodity investments tend to be, 3 to even up to 15-year cycles. And the one I see the most problem with right now is energy investment, energy in refineries, and that's largely due to this ESG overlay. But also we're at that point in the cycle, and there's many commodities that are probably underinvested. But then the final layer of the inflation onion, and that's the core, are these secular drivers that I showed on the second slide. And the one I'm going to focus on is the demographic constraints. And that's the low birth rate, the low immigration rates, and the aging population in the US that's going to drive. And can I get the next slide, please, Christine? That is driving higher rates of wage inflation or per unit labor costs. So wage inflation grew at 2.4% year over year during that 2010 to 2020 decade, higher than inflation of about 2%. But it accelerated to 3 and 3.3% respectively in 18 and 19. And this was before the pandemic. So it tells you that these demographic constraints were in place before the pandemic hit us. And then the pandemic really exacerbated these constraints. And as you can see that the labor inflation, the wage inflation is decelerating from a peak of 5.6 to a peak of 4 to most recent 4.6% in December. However, we need to get down to 2% is kind of the problem here. And what the Fed's concern is that we're going to get this wage spiral inflation when you have these embedded expectations of large wage increases, and that becomes sticky and persistent inflation. So that's their primary fear. And can I get the next slide? And ultimately, over the long term, there's only two drivers of GDP growth, and that's productivity and growth in the workforce. And if you look at this chart on the right, you can see that peak growth was in the 60s and 70s, and we've been on a downtrend ever since. If you look at this chart, or sorry, the table on the left, you can see that the second column is labor force growth, and that's been declining, and that will probably be close to 0% this decade. If labor force growth is 0%, that means productivity growth has to be 2% to get to 2% GDP growth, and I don't think that's going to happen. And I'm not negative on technology driving productivity growth, but we're in a period of flat to negative productivity growth right now. That will turn, and AI or quantum computing will drive some productivity, but probably not in the next 5 years. So that's kind of the challenge going forward. We're probably going to get 1% growth after 2 decades of 2% growth. Next slide, please, Christine. And then finally, so how long is this recession going to last, or when is it going to happen? This is all driven by the Fed rate hike cycle, how high for how long. And if you look at this chart, the blue is broad inflation, consumer CPI, and the burgundy is the federal funds rate. So what you can see is if you look back to the 70s, we had the Fed fighting inflation in this long rate hike cycle. It was 12 years, and it drove 3 recessions. And you can see that the Fed's response, the rate hikes, were coincident with inflation ticking up. If you look at the right of the chart and you look at the most recent rate hike cycle, you'll see there's about a year lag. That's this period of about a year when the Fed was looking at the outer layer of the inflation onion and saying, this is transitory, we're not going to bother hiking rates. So they're way behind the 8 ball on these rate hikes. And I'm not saying that this is going to lead to a 12-year, 3 recession rate hike cycle, but it's not going to be done in a year. It's going to be probably a multi-year process where rates stay high for some period of time. Maybe they come down a little bit from a recession, but then they go up and form a higher high. So that's kind of my take on the outlook and what's going to drive this from here. And that's it for the macro part of my presentation.
Thank you so much, John. That was really, really informative and a little bit scary. So next we have Cameron, who is going to take it still at the macro level, but from a little bit of a different perspective. So Cameron, take it away.
Great, thanks, Christine. Similar to John, I'm going to spend a few minutes kind of framing the M&A market, which I think, as you'll appreciate as we walk through this, is impacted by and has a lot to do with kind of what's going on in the broader economy. I'm going to start at the global level and sort of look at what's gone on over the past really 14 years or so since the Great Recession in kind of 08, 09, and 10 time frame. And when we talk about the middle market, we're really talking about businesses kind of generally valued between 100 million of enterprise value and $1 billion of enterprise value. You know, I think I'll spare walking through year by year and really kind of focus on the last couple of years. And you'll see a pretty dramatic spike in global M&A volume in 2021. That was a global phenomenon driven largely by COVID rebounds on a global basis, including here in the United States. It was exacerbated by proposed tax law changes here in the United States. We'll talk some more about that, which drove a very significant increase in U.S. M&A volume. And what you're seeing in 2022 is a little bit of the hangover from what happened in 2021. Again, exacerbated by weakening economic conditions, as Jon just walked us through, higher interest rates and financing costs, and other sort of headwinds, which we'll talk about. Next slide, please. If you sort of look then at just the U.S. M&A volume, a couple of things to really focus in on. Again, focusing on that 2021 spike of volume, you've got that post-COVID recovery, very strong economy, generally speaking. You've got low interest rates, you've got historic valuations, all of which, kind of fed into a frenzy, which was then exacerbated by some proposed tax law changes, which then created a tremendous amount of urgency to get deals done in 2021. I think most folks in my profession would tell you that 2021 was sort of a career year in terms of getting deals done and activity levels. 2022, by contrast, has really been marked by some headwinds around the economy, inflation, labor issues, all of which have impacted businesses' ability to execute consistently. Some geopolitical headwinds around Russia and Europe and other parts of the world. And then rising interest rates here in the U.S., which in particular has driven a very dramatic increase in the cost of financing transactions, particularly in the back half of 2022. So, you'll see on an annualized basis, 2022 is likely to be about half the volume that 2021 was from a deal number of transactions as well as deal value standpoint. If you flip into the next page, kind of then look at where are those buyers coming from for U.S. businesses. You have another very interesting dynamic going on. Again, focusing in on 2021. Significant number of acquirers coming in to buy U.S. businesses from Asia, from Europe, as well as other geographies. I think driven largely by the outperformance of the U.S. economy in 2021 relative to other parts of the world, and a number of attractive targets in the U.S. In 2022, by contrast, foreign buyers of U.S. businesses have largely evaporated, and seeing a dramatic decrease in total inbound investment into the U.S. A lot of that's driven, I'd say, more by the economic conditions in the rest of the world than by in the U.S. But as you think about, an M&A market as a competitive set of buyers for any particular business, we've definitely seen a pretty significant retrenching by foreign buyers of U.S. businesses. If you then kind of can flip to the seller side of that equation, who are selling, the middle market has always been dominated by private sellers. These are family founder-owned businesses that have built up enough value to seek a transaction in that $100 million to $100 billion size range, and you can sort of see again the spike in 2021 and the dramatic drop off here in 2022. The yellow line represents what's going on with private equity transactions in that same size range. And you can sort of see pretty much the exact same effect in terms of the drop off in private equity sellers going on in 2022. We expect that to pick up in 2023, and I'll talk some more about that in a minute. And then lastly, kind of setting the stage, talking a little bit about kind of what's going on with valuations and the ever important thing everybody wants to know is, how do I maximize the value of my business? 2022 saw really the first decline in private equity dry powder in a decade. If you think about private equity dry powder is a measure of the buying power of private equity firms. If you look at just those middle market private equity firms at the end of, or sort of, in September of this year, or 2022, we saw dry powder of about $429 billion. When you add leverage to that, that really kind of equates to almost $1 trillion of buying power. So very significant buyer of or source of capital to acquire these middle market businesses. That private equity dry powder fell for the first time in this year. Largely it was as a result of kind of two related things. The first is, in 2021, we saw record levels of private equity deployment, which drew down these funds. And then 2022 has been a very challenging fundraising environment, tied more to what's going on in the equity and debt markets than what's going on in private equity. But the ability to sort of replenish those funds has been a much more challenging environment. From a valuation standpoint, looking in the lower left, in 2022, we've seen a decline in buyout multiples. So these would be the transaction multiples that private equity firms are paying on average. So those multiples declined really for the first time in many, many years, from 14.5 times EBITDA last year to 13.8 times EBITDA year to date. And the biggest driver of that has been a decrease in the amount of leverage or debt available for these buyouts. The decrease in amount availability of leverage is tied directly to rising interest rates, and we'll continue to see that effect on the overall market, and by implication valuation going into 2023. I think lastly on this page, the one area or sort of bright spot, if you will, is as private equity firms are competing for businesses to acquire, even though leverage availability is lower, given that huge amount of dry powder and a belief that over time borrowing costs will come down again, they are putting in more equity into these deals than they might have otherwise done, which has moderated the decline in valuations a little bit. So just to kind of summarize all of that in a couple of key slides. In 2021, record dry powder for private equity, very aggressive strategic buyers. We had, quote unquote, normal inflation, and that we all believed it was transitory and supply chain driven, as Jon shared. Record low interest rates, post-COVID optimism, sort of a tax-driven reason for folks to explore a sale, and certainly some what I would call seller burnout or COVID burnout. Basically, baby boomers who've decided through the first 2020 COVID year that they needed to exit, and that 2021 provided a very strong market for them to do that. 2022, had a couple of the same factors. Interest rates began to rise. I would say, if you looked at 2022 in whole, the sideways bar is the right answer. If you look at it today, it would be a negative arrow, just as rates have continued to increase in the fourth quarter of 2022. That post-COVID optimism has certainly gone away, particularly as those people have continued to deal with supply chain issues, labor issues, and inflation-related issues. We don't have a tax-driven reason, or at least last year, for people to sell, and certainly don't anticipate it this year. And so certainly a lot more balanced market in 2022. And so that has really played into a market today, as we sit here now, that is relatively bifurcated. There's probably, very interestingly, a set of transactions in today's environment that could get done with almost no impact on multiples from a year or two or three ago, and those are maybe 10% of the deals that come to the market that would be extremely high quality companies. And every other deal, so 90% of the deals out there, are seeing a pretty meaningful impact valuation, somewhere between 1 and 3 turns of EBITDA, lower multiples than where we were just 12 months or so. But why are we still optimistic about 2023 and the fact that the floor for valuations won't completely fall out is you still have a very strong set of strategic and private equity buyers out there. It's still very challenging to build through greenfield versus M&A. Buyers, while they're being more selective, are being more aggressive for the opportunities that are core to them. And middle market debt markets have tended over time to perform much better than the large cap environment. So 2023, and I think we lost the presentation, but I'll just keep going. I'd say if you, I don't think the presentation's up, but we across our practice look at our 50 plus clients that we're working with on any given time, and we track their performance, their actual business performance in this economy. And as we sit here today, we've got about a little over 60% of our clients are performing either at or better than expectations, which tells you there's still a lot of great things going on in the economy. But it also tells you that about 40% of our clients are underperforming what's going on. And that has a lot to do with the headwinds that Jon and I mentioned previously. So what do we do in these types of environments to help our clients think about preparing for and executing on transactions? Is really the same kind of blocking and tackling that anyone would do in a regular market, but with much more focus. That's focused on, making sure that stakeholder goals are well laid out and communicated both to advisors and internal constituents and potential partners. Really focusing on comprehensive preparation. having a management team that's deep and prepared to have conversations with buyers, and then kind of taking all of that and focusing in on really timing a market launch for the right time in the market. And with that, I think I'll wrap it up.
Yes, thank you. Thank you so much, Cameron. Sorry about that glitch, everybody. We just had a big power surge where I am. And so with that, Paul, talking about big and power, what of these macro economic conditions are you seeing within your client portfolio, and what are you doing to help?
Thanks for saying, and I hope that you're not in the Bay Area or somewhere in California where you're incurring storm damage. Look, we had Jon at the 30,000 foot level. We had Cameron who brought it down to about the 20,000 foot level. My objective here is to get to the tree level, and then ultimately Brenda will get down to the individual company level. Xenonarc's perspective and where we're coming from is, we currently work with 17 global clients, and we service on their behalf tens of thousands of end use customers. So our perspective now, is bringing it down to the day to day in a portfolio of different businesses across a variety of different industries, right? So our concentration. We are pretty evenly split between food, food as in food ingredients, not necessarily end use food, and then industrial. And we really are servicing hundreds of sub industries. Some of these are metalworking, lubricants, water filtration, case, oil, wax, polymers, so on and so forth. And our small business customers, our average order size is across our portfolio is about $35,000 per year. So what that tells you is we're talking about a highly diversified end use customer base that we are constantly trying to keep our finger on the pulse of what's happening within, let's say, the North American marketplace, but we also have operations in Europe and also in South America. If you go to the next slide, please. For us, we do, in our attempt to try to keep a finger on that pulse, we do quarterly end use customer surveys. And we try to keep it really, really simple, right? Like what are these end users thinking today about what they expect business to look like? What are their backlogs? And what are their inventory levels? And how are they communicating to us they feel that they are positioned to call it, weather the next sort of 6 to 12 to 18 months, whether it's up, down, or sideways. And if you take a look at forward demand, for example, we have 68% of our respondents, of which there were just under 360 last quarter. We see almost 70% signifying that their demand or their business is either going to be flat or actually decreasing. Reflecting that is also sales backlog, same type of trend. And then obviously for us, because we buy and resell products, get a deeper understanding as to what their overall inventory levels are. And most are feeling that their inventory levels are actually probably either in line, which means it's probably too heavy, or in fact they are slightly over inventory. So when we think about Jon, Jon's comments in terms of manufacturing, and a 1% increase, which is a deceleration from last year, we have to work through these gluts, with some of these small business customers being perhaps over inventoried because they over purchased when supply chain was very tight in the call it first and second quarter of last year. So now if we take a look at market trends and the demand outlook on a quarterly basis, and you can sort of see how, whether it's in line, whether, or flat, whether they think it's going to decrease or whether they think it's going to increase, end use customers again. You can sort of see how the in the third quarter, there was a pretty pronounced sort of jump in sort of those respondents who felt that there was going to be a slowdown. And we've lost the screen again. So we will adjust here very quickly, and I will do my best to explain to the audience. But yeah, between the gap between second and third quarter really saw the most pronounced sort of what I call negative shift in overall end user sentiment. We need to go up one slide, please. Up a slide, not down. One more. There we go. Thank you. So we saw what I would call a weakening of the outlook, basically between second and third quarter. But what we're seeing now is what I call a more moderating. It's still moderately negative, a negative bias, because we see fewer people viewing that the business is going to increase, and more are feeling of our end use customers are feeling that their business is either going to remain flat or slightly decrease. If you go next slide, please, Christine. Thank you. So what are we seeing in terms of our overall book of business? And some of this, there is some seasonality to be factored into this, but you can sort of see what our bookings are and what our backlog is. And you can sort of see December 2021. You can see that we were in terms of our bookings, we had roughly 1.9 times sales. So basically, we had almost 2 months advance warning. At the height of the supply chain issues, you can sort of see in sort of mid to late second quarter, that number was sort of at 2.5 times. That was telling us that end use customers couldn't get product. And if you take a look at our backlog and how the backlog spiked, but as that negativity started to creep in, you're starting to see orders and bookings pare way down, and finally supply chain was catching up in most cases, and so the backlog either decreased because we were able to fill orders, or orders were canceled, right? And so again, back to the if you think about the previous slide, you had people going, I'm looking ahead, and if we can cancel orders, we will, because we don't want to be over inventory. What we're now starting to see as we go into current day levels is things are moderating. We are starting to see a return to bookings, close to 2 months out, and backlogs are starting to moderate. Down the bottom, you can sort of see, and it's a bit of an eye chart for you, but you can sort of see what some of the trends are, whether it's on the food ingredient side or overall industrial. And for us, we saw food ingredients had been really where the bulk of the pressure really was. You had the geopolitical war in Ukraine. You had China holding back. You had instances where you had food manufacturers not being able to get labor. So there was a real sort of cramp in the overall supply chain there, which now feels like it's moderating. Industrial has been going a little more consistent, not with the same volatility as the food side. And what we're seeing now is moderating, or what I call hopefully more returns to normal on the food side. And industrial is what I would just call is still hanging in there. If you go to the next slide, please. So what is it that we do, and how are we handling what I would call this sort of volatility, especially as we look out in terms of what we think will be a weaker, certainly a weaker 2023 on a same-store sales basis. Is for us, it's really important for us to control what we can control, and we make a real hard commitment to understanding the specific needs of small to mid-sized businesses, right? And this is, and remember, we are servicing these end-use customers on behalf of our clients. And if you break it down to overall core competencies, we want to make sure that our major clients can focus on their core competencies, which is going to be product development and innovation. It's going to be supply chain excellence, manufacturing. And then the third piece is their ability to take care of their large strategic customers, right? The ArcelorMittals, whether it's the Kraft Heinz, Mondelez's, whomever. Our raison d'etre, our reason for being is actually taking care of SMBs. We understand what it is that they need. And so our job is to strengthen that connective tissue between the major manufacturers and these end use customers. And we, through 11 years of history, combined with going out and soliciting third-party qualitative research to understand the SMB customer base, have really determined and discovered what are the SMB business priorities. And really what is they want, and this is where there's often a disconnect between the major manufacturers and the SMBs. Major manufacturers always think that this is a price discussion, right? Oh, well, if we give that small business customer the right price, they're going to buy. And that's actually a misconception. For us, what we understand is, and through research is, these small business customers, and small business customers are probably $20 million of sales or less per year on their own aggregate basis. Remember, I said our average customer size is about $35,000 a year. Is what these small business customers want in priority here is responsiveness. They want someone who's going to service them. They want that reliability. So if they pick up the phone and call, or they email, or they engage in some which way, shape, or form, they get a phone call or some sort of response, like quickly and reliably, like they can, so they can be counted on. The next thing they want is technical expertise. So someone who knows the products, who knows the portfolio, who can help them with their formulations or problem solve or whatever. The next thing they want is availability. And the fifth element here is price. And so that's, again, where there's that, again, just to reemphasize, that's where there's typically a misalignment between the major manufacturers and these SMBs. So what do we do? Obviously we understand the requirements. You can draw those conclusions fairly easily. But for us, what is it we do? Look, our number one focus, everything we do, is based on holistic customer intimacy. Is understanding when, where, and how a customer, an end-use customer, wants to engage with the brand, right? With any one of our clients' products and solutions. And it has to be omni-channel, right? You can't just rely on a phone call. You can't just rely on an in-person visit. You can't rely on a text. You can't rely, simply on some sort of online e-commerce mechanism. It has to be a true omni-channel solution to engage with customers seamlessly across each channel. Again, then we also make sure that we have these dedicated teams to make sure that we are providing the appropriate technical advice and support that will engage and help these SMBs who are typically resource constrained. We want to make sure that they've got all the resources available to them for them to be successful. We utilize this through proprietary technology. We are really a tech-enabled services business, and we want to make sure through our technology we can put together a holistic, a full mosaic of each individual customer. I'm not talking about customer segment. I'm talking about each individual customer, a mosaic, so that way we can anticipate and predict and usher resources to help them be the most successful versions of themselves. And then, of course, we support this all through data. Like we have behavioral analytics to make sure that, again, using that technology, we are drawing what I call actionable insights that we can either use and respond to for our own servicing of the customer base, but we can also then relay those back to our manufacturer, full transparency, so that way we can collaborate with our manufacturing partners to help drive, whether it's better supply chain metrics, near term, new product development, new marketing campaigns, in order to drive the business forward. So for us, it's really all about making sure that our clients are very aware of what's happening in the marketplace, and and being in constant contact, as well as helping our customers navigate what are going to be I think pretty challenging times. On a relative basis, probably second, third quarter before we start building back up. And with that, I will kick it back to Christine to go to Brenda.
Great, thank you, Paul. So Brenda, that 95% on time in full delivery, that is something in the industry, as you've just seen through all these slides, that is outstanding. So I'm going to let you take it away and tell us how Edlong services clients.
Sure, great. Thank you. Good morning, good afternoon, everyone. Well, first off, a little bit about who Edlong is. We are a privately held, woman-owned flavor company specializing in dairy. We've been in business well over 100 years. We are global. We're based right outside of Chicago. We have operations in the US, in Latin America, and Europe. And we service the food industry and many channels and markets. When anyone hears dairy, they always think traditional dairy, which we're definitely a part of. It's a big part of our business. But much of our focus is in plant-based and vegan. And we're in many of the products you see in the grocery store shelves every day across snacks and beverages, nutritional and bakery. So that's who we are. And go to the next slide. We've talked a little bit about reflection on 22 and the volatility. And I think our mantra for 2022 as an organization was flexibility. And the graph I have here shows kind of the order change requests that we had throughout the year. And you could see in early Q1 of 2022, we started to see spikes in order change requests. And that volatility was really from customers. They weren't able to get all of their ingredients. So when they couldn't get everything, they didn't want anything. So we were having customers call and specifically asking to move orders out maybe 4 or 5 weeks. But what would happen 2 or 3 days later, we'd get a call from that same customer asking for the product the next day. So with that, we had to really be strategic in our working capital management. And again, I am really proud of the fact that our team was able to have over 95% on time in full throughout 2022. We know much of the industry slipped below 60% in that metric. And much of that was really just a decision by our organization that being private, we could go out and say, what is important right now? And the most important thing was servicing the customer. So we were able to make some very good decisions around inventory and raw materials to put us in a very good position to do that for 2022. And on the next slide, really that comes down to agility and what we were seeing. And we had to take a step back and say, what's been in the past isn't necessarily what the needs are today. So we had to align with our customers and listen to them. And what we were finding is innovation was absolutely lagging at the consumer packaged good companies. They've had to pivot, right? They had to focus on SKU rationalization, overall portfolio management. And what we started to see was a lot of these big brands were just discontinuing SKUs. What that allowed them to do was take out the disruptions for ingredients they just flat out couldn't get anymore. It allowed them to focus marketing dollars on the items they could get to consumers. And it simplified their capacity and inventory management. Also, I think we heard a lot in the news in mid-2022 about retailers just finally saying to the big brands, we are not taking pricing actions anymore. We're done. And therefore, the brands only had a few options, one of which was to take lower margins, and their margins were already squeezed as it was, or they had to start to look at changing packaging. And that was either packaging form or size. And in many cases, it was just simply shrinking the actual store shelf size that consumers were getting for that same price. So what did that translate into for us? Softer demand. And it's across our industry. And you've heard the rest of the guys talk about it. We've seen higher than normal attrition levels within the food industry over the last 12 to 18 months. So if we look at the next slide, we have to say, well, what are our customers focused on? What does innovation look like today? And what we're seeing is really innovation has to be simple and easy, because consumers still want something new. They still want to go to the grocery store and say, can I have something that I can try? But it has to be cost effective. And the CPG's innovation strategy is around easy flavor updates, which means they don't have to invest in equipment. They don't have to invest in new manufacturing, but they can have a solution for a consumer to keep them excited about their brands. And with all the product packaging changes, there's been some opportunity to showcase the products in a different way. Another strategic area where we're very focused on with our customers is around labeling. Consumers are looking for clean labels, gluten-free, and some of this other terminology that's important to them. So we're strategically partnering and looking at the labels across our ingredients and into the end product and how we can support that. While we've had all these supply chain disruptions, another key theme that we've seen is dual sourcing. Throughout, you've heard about preferred vendor programs, and you've heard about reduction in vendors to make it easier for companies, procurement people to work. Now we've seen a shift back to say, you know what, dual sourcing is important when, especially when these companies could not get ingredients and they did not have a second source. So we're jumping in and supporting in some of those opportunities as well. And of course, as we look at cost, quality is key. And so we always have to maintain high quality levels. That is the expectation. The consumers are not going to expect anything different, so our customers have to as well. And I'm just going to echo Paul. I think at the end of the day, what we're hearing more and more, it has to be customer intimacy. We have to be a trusted partner and a collaborator. That's what's going to reap success as we look into volatile times. We have to be the people that they can lean on when they need it. And, you know, there was an interesting McKinsey report at the end of last year, and there was a quote that I pulled out here that I think echoes everything we're talking about. And that is CPGs, they're going to need to mitigate risk, and they're going to push that down to suppliers more and more. So those of us in the supply network that can step up and be that trusted partner and be there to help them do that are going to succeed. And that's what we're looking at. So as we look at the next slide where our investments are, really, we are continuing to invest to support everything we're talking about. And it really comes around a collaboration. We want to deliver not just a product, but services on top of that product. So R&D support is critical. And I'm really proud to say that we've added headcount and added and invested in people throughout the last couple of years where you're seeing some of that shrinkage. We want to be an extension of our customers. We're also investing in manufacturing and application expertise, but this is on our customer side so that we can mimic their processes to understand how our products interact with their type of supply chain scenarios. And we're going to continue to focus on our strategic working capital plans. Inventory is king. I still believe that. We have to have the right inventory and the right materials. And this is tricky right now with the changes in the commodity pricing and markets. We have to be smart in how we do this to keep our customers supplied and supplied at the right price. But also adding other services like sensory and analytical tools. So we're not just giving them a product, we're giving them data and information and analytics around those products. And, you know, it's not just about price. I'm going to echo Paul again, but we got to talk about return on investment of these flavors. So not just what the cost of the product going in is, but what is the end consumer game? Where does this get the product and overall growth from the retail shelves? And how can we really calculate that for them? And technical to technical is critical. We want to stand shoulder to shoulder and ensure that our teams can work together. So we are investing in spaces to make that easier and that collaboration much more quickly and in the right location geographically. And there's something new that we've seen kind of in the end of 22. And I see this continuing, and I think this is key to our future in the food industry, which is collaboration across ingredient suppliers. So bringing companies together in tandem to work for these CPGs to get an end product. So for example, you have a supplier of a protein, a supplier of a starch, and a supplier of a flavor working together, understanding the brief and understanding how our components interact and what happens during that interaction to be able to deliver products quicker to market and faster solutions for CPGs, which at the end of the day saves money. And with that, we're excited about the future, and I'm excited to see the questions that we have come up from all of our participants. So Christina, I'll throw it over to you.
Thank you, Brenda. And thank you, everybody. I hope you can all stick around for about 30 more minutes of Q&A. We already have a lot of questions in the chat. This first question that we got, I think really would work best for Jon and Cameron to answer. Cameron, I'm going to start with you, and then Jon, you can kind of follow afterwards. But from a macro perspective, where do you think the world, when do you think the world economy will start improving? And are you surprised at the resilience of our global economy?
Yeah, thank you. I'll jump in here. I think from our perspective, as I shared in my presentation, certainly some of our clients have continued to enjoy strong performance, and some have been underperforming. I think we're going to see an environment, at least for the next 6 months, where that continues to be the case. I'm more optimistic in the back half of the year. Part of that, I think, is just uncertainty. Uncertainty from a transaction standpoint is a challenge. So the less uncertainty there is, the easier it is to get deals done. And I think as we go through this period of transition here this quarter and next, we'll continue to see that uncertainty headwind. But in the back half of the year, I'm much more optimistic.
Great. Jon, what are your thoughts?
Well, so if we look at the U.S., I think my views are a bit flipped versus Cameron's. My view is that what's holding up the U.S. economy right now is a strong labor market, because companies, cut too much headcount during the pandemic. They're now holding back and on doing headcount reductions, and it is actually the middle market that is supporting the labor market right now. It's not the larger companies. So I think that tends to go on, and I'm watching as a leading indicator of unemployment claims. But we also have a tremendous amount of excess savings of the consumer still from the pandemic, combination of stimulus payments and not being able to spend the money. And that was, at one point, it was 2.2 trillion. We had 0.7 trillion of this savings, but we still have 1.5 trillion left, and it's pretty broadly distributed, more skewed to the higher income deciles. But even at the bottom income deciles, there's still a lot of savings. And then you have this lagged impact of Fed rate hikes, because most debt in the U.S. and the world is term debt, and that takes time to roll over. And as that rolls over at higher rates, and it becomes a drag on growth. So I tend to think the recession, happens towards the end of the year, and my base case is a mild kind of couple quarter recession. In terms of globally, so China's interesting case, because they have this Omicron outbreak and they had to back off their zero COVID policy. So I think they're going to have a very sharp downturn. But if we look at other countries and how quickly Omicron ripped through them, specifically South Africa, that happens over a couple of months. So they're probably getting 5 million cases a day right now, but they're not reporting, they're not testing. So we'll see them emerge much quicker than the consensus, and that will help drive up some growth for U.S. multinationals. And that will drive commodity pricing. And I tend to think that goods inflation is near a bottom now, because of the commodity underinvestment I talked about in oil due to ESG. China is the biggest consumer of oil, and they're going to come back on. And so $70 is a nice floor, because it's also where Biden is replenishing the strategic petroleum reserve with 200 million barrels. So goods inflation is probably near a bottom, and as China rebounds. And then finally, if you look at Europe, Europe is more troubled. They'll probably have a multi-quarter recession with slower growth for some time. And I don't know what the catalyst for that is. We don't export much to Europe, so it's kind of an island there. But yeah, so that's my take on it.
Thank you. So we just looked at some macro questions. So from a micro perspective, I'm going to pass this one to you, Brenda, first, and then also to you, Paul. But when would you expect the full impact of any recession? And when do you expect an uptick?
Yeah, I think from our perspective, what we're seeing, it definitely is going to be, late into 23 until we see any kind of uptick, kind of late Q3, Q4. I think what we're seeing is a lot of the project briefs and requests that we're getting are still coming off the tailwinds of all this supply chain disruption. And we're not seeing a lot of innovation. It's kind of status quo. And I think the CPGs that we're hearing from still just want to make sure they're delivering expectations to consumers before they try to do too much new. So definitely going to be the end of 23.
My take on it is, look, I originally thought that, if you'd asked me 2 months ago, I would have thought that this recession was going to be meaningfully deeper than my current perspective. My view is moderating. There are a couple of reasons for that. I think what we've learned certainly over the past 3-4 years is that these major manufacturers are actually a lot more nimble and agile than they were, let's say, in 2007, 2008 during the Great Recession then. So I think their ability to get their supply chains and their inventories back in line more rapidly is definitely there. I think also the outcome of the midterm elections, there wasn't a red wave. There's a fractured Congress. There's what I call a return to sort of the middle, which will mean that yes, we're going to have to endure some pain because we do have a glut of inventory. We have an excess of supply. As John mentioned, there's still demand out there. There's still discretionary dollars to be spent. But what's happening is the consumer, I believe, is learning how to reprioritize and is finding a new equilibrium for their discretionary spending. Yes, we are dealing with higher fuel prices. We're dealing with higher food, but it's coming at the expense in other areas. But I don't think it's dramatic, and so I believe that we're going to see the bottom probably in second quarter, third quarter. By fourth quarter, I think we'll start to see a recovery because 2024 will be an election year, and the incumbent party is going to do everything they can to basically try to make things, the economy. Remember, Bill Clinton said it's the economy, stupid. The incumbent party is going to do everything they can to basically go into the elections on an upswing. So I think, and I'm not necessarily hearing those exact comments from our end use customers, but we're hearing certainly similar comments, but not necessarily for the same reasons. So that's my overall perspective.
Thanks. Hey, John, I want to come back to you. What are the leading indicators you look at to help provide an outlook on those future economic conditions?
Hey, John, you're on mute.
Apologies. Yeah, so kind of the ones I looked at on the first slide are the leading indicators. I would say that the non-farm payrolls, they're lagging in a downturn, leading in an upturn, so ignore that one. But new unemployment claims would be the one for labor market, and they're still very healthy. And then the consumer spending, there's lots of different measures of that is a key one. Industrial production, but we're kind of in a situation here, I think, that where the leading indicators are not telling the story. you have to make this assumption that you don't fight the Fed. At some point, the interest rate hikes have the desired impact of slowing the economy, and a soft landing is just it's kind of an elusive target. So I tend to look at more the longer term indicators, and then the leading indicators will show us essentially when we're in a recession. Usually what happens is you get GDP revised upwards, backwards looking, and that tells you, wow, we were in a recession, right? So the econ data doesn't tell you in the leading sense. You see that in companies' business, but you don't see that in the econ numbers as it happens.
Yeah. Cameron, we had a very specific question come in for you, and it's as an M&A banker, how are you advising your clients to best position themselves for a liquidity event?
Yeah, I think the advice, holds whether it's a challenging economic environment or a booming economic environment. And it really boils down to, in an easy way to sort of think about it is mitigating risks. So any buyer is going to be looking at a set of risk factors related to a business. A lot of times those will be around management, strength of management, breadth of management, depth of management. They'll be around markets, end markets that you serve. Are they, strong, consistent, large and growing? Customers, do you have a broad and diverse customer base or a concentrated customer base with, one customer that makes up a significant portion of your business? And then I think, just kind of, a strong business plan in terms of, how to continue to grow your business. Is there growth in your business and the markets you're serving growing? So you sort of think about those 4 or 5 major buckets and, positioning your business to maximize the sale is all about doing everything you can in your power to mitigate any risks in any of those categories. And so, bolstering management teams, succession planning, making sure that there's depth in the team and that they can support the growth that you're forecasting. All those sorts of things, just kind of going through and ticking the boxes in terms of mitigating those risks.
Great, thank you. I have a question, and I think Paul and Brenda, either of you could answer this, and I want to hear it from both of you. So let's start with Paul. Not all companies are poised to succeed in this environment. What are your companies doing to drive performance?
Yeah, I think for us, it comes down to fundamentals, and it's the consistency, if not the increase in investment. And the number one thing that we invest in, and this is going to sound hokey, but it's trust, right? We are taking measures on a daily basis with both our clients and our end use customers, and quite frankly, our people as well, to further instill and develop and build trust. It's built over time, it's built and earned over time. And we have to make sure that we continue on a daily basis to not only earn, but also to call it, stock more trust in that account. And so for example, we build a trust through the deployment of our XA Direct model. And when I think about it from our client's perspective, like right now, they need us more than ever. As we go into this, period of broader economic uncertainty. Like many of them are restructuring, and their attention is they are distracted with their own internal measures. So they need to know that they can rely on us to be able to handle, let's call it anywhere between 10 to 20% of their customer base and their sales, or excuse me, in terms of numbers, it's probably 80% of their customers, but somewhere between 10 to 20% of their sales with us. Furthermore, they've all been through some form of supply chain hiccup, whatever constraint, and some are still suffering through that. it's up to us to help them, make them more effective by, instead of ordering in pallet sizes, ordering full truckloads, whatever it may be, to reduce the amount of complexity that is going on, within their business. And then the third thing is, look, they need to make sure that they can, continue to keep their finger on the pulse of what's going on in the marketplace. And through our technology and through our close partnerships, on a real-time basis, with data, it isn't ad hoc type information. No, they can see with real data in terms of what are the dynamics within the ever-evolving customer base. For us, then so now it's back to the customer. So now the deployment of the XA Direct model, so from a client perspective, we just talked about, now from a customer standpoint, is making sure that we are there when, where, and how they want to engage. Because right now they have more choices than ever, right? Because of the supply chain dislocations, as Brenda mentioned, suddenly secondary and tertiary suppliers came about. There's more competition. So how are we helping our customers, answer their questions, technical questions, reliable, respond, whatever it may be? But we want to make sure that we are there, as I said before, putting together this mosaic, this custom configured service mosaic for each individual customer. And then we go, okay, how about, now, Paul, how are you doing that? That all sounds great. Well, we at Xenonarc are actually making the single largest tech investment we have ever made since our inception this year. We are really focused on investing, in our business, in that XA Direct model, whether it's people and technology, to make sure that we can continue to sock away excess trust dollars with both our customers and our clients. It's all about that trust. So as I said before, everything we do is to really strengthen that connective tissue bond between our manufacturers and their brands and the end use customers. And it's all about continuous investment.
Brenda, I'm going to change up the question just a little bit for you. We just heard Paul use the word expectations, and I've been reading a lot, and a theme for 2023 on a global perspective is that 2023 is going to be the year of expectations. So how is Edlong, setting customer expectations among all this uncertainty that we, just heard about?
Yeah, I think that's a great question. I think at the end of the day, we are pushing strongly for open dialogue, two-way communication and collaboration is it's critical, just to level set, right? That everyone's on the same page. And what does success look like? I think we've been very flexible. We've been agile in response to the customer needs. And as we see some of the stability, I think it's important to balance the now with the long-term view so we can plan for the future. Let's not just be in this reactive mode, but how do we start to take a proactive approach? And I think that's really, really critical with the customer. What are we doing right now? But also, what does the future look like, and how do we prepare and stabilize? And I think we want customers that don't just say, hey, what is the price? And yeah, okay, I'll talk to you next year. But where do we really partner and support and have the long-term view? So I'm going to echo Paul on that trust piece. Trust is also a two-way street. And I think we're doing everything in our power to show, the trust that our customers can instill in us. And then we want that to be reciprocated. But we also know that we have to invest in the future and keep investing. So we're always bringing something new to the table. But we believe it's just all in the relationship building. It's not just you have one boots on the ground talking to one procurement analyst, but really engagement from all aspects of our organization with our customers, top to top, technical to technical. How can our marketing team support your marketing team, and so forth? And I think it's that open dialogue and open collaboration, and that's when we truly see success.
Great. We have time for one more question, so I want to ask the question to all of the panelists, and it's from each of your own perspectives. And I can start with Jon and kind of go macro, micro. So I'll start with, we'll go in the same exact order as we had our presentations. But how do you halt fear and inspire motivation, communication, and teamwork through 2023?
Starting with me?
Yep, starting with you.
Yeah, so I think we have to kind of accept recessions and slowdowns as kind of opportunities. They happen. They've been happening less often more recently, and they've been shorter in duration, but they are a part of the business cycle, and I think we just view them as a time to kind of huddle down and focus on our core competencies, and work on the product side and the automation side, as opposed to worrying about when the market or when sales are going to improve.
All right, Cameron, your turn.
Yeah, I think for us, it's really just about being in the market and being present with clients and prospective clients, and being not afraid to have the conversations, whether they're easy conversations or tough conversations about the market and the prospects of a transaction. And I think as long as, at least for our team, as long as we're, out there and having conversations with the market, it keeps our team engaged and excited about what we're doing, even if business might be slower. We're not seeing any slowness on our business today, but certainly as the year develops, that could happen. But as I said, just encouraging people to be out in the market and having conversations, and either transacting or building dialogue with people who want to transact down the road.
Great. Paul, your turn.
Yeah, I think I will echo a lot of those sentiments and perhaps build a little bit on it. Is look, I think authenticity, right? I think when you have, and this is now, moving a little away from the services industry, that Cameron comes from. I know Jon gets it and Brenda gets it, but authenticity of a corporate culture is going to be really, really important. And then, in that, yes, I 100% agree with the concept of visibility, right? You have to be visible with your clients. For us, we have to be visible with our clients. We have to be visible and proactive with our end use customers, and we have to do the same with our people, right? We are all naturally human beings, and we're not artificial intelligence robots. We have emotions, and so I think in that it's going to be really important to be visible, transparent, right? You got to be honest. Sometimes you have to be prepared to deliver a tough message. Sometimes you have to be prepared to receive a tough message. But that's where the honesty in partnership is very important. And then proactive communication. I think in order to really inspire and motivate someone, I think those are the key ingredients, because ultimately that results in trust, and you want to do business with business partners whom you trust.
All right, Brenda.
Yeah, what I would say in times like these, there's no such thing as over communication. I think it's very important that we have clear goals that everyone understands. And sometimes you just have to simplify. We don't need 42 metrics to say whether we're succeeding, but maybe there's 3 or 4 things. If we do those really well and everyone understands those, and we measure those very clearly and communicate that, you start to get a feel for whether we're getting momentum. And you have to celebrate the small wins, right? Take the time with your people to celebrate the small wins, because it'll just keep the momentum going. I think for us, we are global, but it's really important that we bring our entire team together quarterly. And so obviously we do that over a Teams or a Zoom meeting, but we say, hey, here's where we are. Here's how we're doing. Here's some wins we've had. Here's a few areas for improvement. And this is what we're going to work on the next 90 days. And we chunk it up like that. And again, and we hold ourselves accountable. So if we say we're going to do 14 things and we get 12 done, we just call it out and say, here's how we did, and we're moving forward. But communication is king, and easy metrics that make sense.
Great, perfect. Well, we are out of time. We still have a lot of questions in the queue. So what we're going to do is I will distribute all the questions to the panelists. They'll get feedback, and we will summarize all the Q&A, including the questions that were asked during this segment. And I will get those out to everyone on the call, as well as the webinar, which is on demand.